Hello, welcome back to my channel. I am Soren, and today I'm going to be talking about a very hot topic, which is how to start investing, and wait for it, during a recession. And this isn't bond investing, this isn't real estate, because both those markets are relatively unchanged in the recent events by the thing that cannot be named on YouTube. And basically this is about stocks. And this also, I'd like to say and make very clear that this is not day trading, these are not penny stocks, this is not gambling. This is using calculated measures to make you more money in longer periods of time. It's not a get rich quick scheme. It is how you can make money over an extended period of time, and if you do it right, you can make a significant amount of money. Okay, now let's get into this video. So what just happened? So obviously the market went down, and have we hit bottom? Is it too late? Questions like that. So the first one is, I don't know if we have hit bottom, and I don't think we'll ever really be sure until after we've fully gotten out of this. So it'll be interesting to see. Obviously, one of the reasons for why the market's gone up is because there's a $2 trillion bailout that's currently happening, which restored confidence and made the prices rise. Will this continue? You never know. It'll be interesting to see. But in any case, the stocks are still at a cheaper price than they were before all this. So no, you're not too late. You still have plenty of time, but I'd recommend doing this sooner rather than later, because the later you do it, the less time you have to grow your money. Okay, so in business, there's the idea of location, location, location. And stocks trade in basically the same location, location, location. So then you have to think about, it's all about getting the right price. And that price is all about timing, timing, timing. So now that we've got that, this is like a Black Friday sale for stocks. Everything's down, everything's cheaper, and it's a great time to buy. Classic buy low, sell high. This is low, just remember that. It's not that complicated, you just need to remember it, think about it, process it, know what now is. Okay. Now, there are 5 things you need to know to be a value investor successfully. You need to follow these like a religion. Number 1, you need to understand the type of company that you're investing in. You don't need to be an expert, which a lot of people think you do. You need to understand what they do, how it works, and why some numbers in that industry are worse than others. Also, what numbers you should be judging those companies on. In today's video, that's what I'm going to be talking about for the majority of it. Another piece of this is that your opinion doesn't really matter. If you buy a stock, the stock price doesn't go up or down as it shows. You need to realize that, and realize that if you have a certain style, great for you, but that doesn't dictate the whole world. So in this is a field where you have to be focused more on the numbers than you are on yourself. In that same sense, don't fall in love with your stocks, because you have to look at them very objectively, because otherwise then you can end up losing lots of money. Okay, with that first important point, remember that, and if you need to watch it again to fully understand it, I recommend that you do. Okay, so for the first actual number, this is ROE or ROIC, which ROE is return on equity, and ROIC is return on invested capital, which basically sound like the same fancy term for the same thing. And you wouldn't be fully wrong in saying that. And in both, it starts with the return. So this is how much money you will be making. This is what a lot of people like to talk about. There are other things which I'll mention which are also pretty hot topics, but this is probably one of the coolest ones, because this kind of predicts how much money you're going to be making. Not fully though, don't fully go with that. So this is basically, you want to be higher than 20 for both of these. But first I'm going to talk about the difference. So ROE, return on equity, is basically the return, like if you put $1 in, how much money you're getting back. And then the return on invested capital is that, but it's also when you factor in the debt. So you could have a super high, like insane ROE, and then you have a really bad ROIC. That might not be a great company because it has a lot of debt. So you have to think about this. But there are also some industries, as I mentioned before, where some numbers might be worse, like debt. Again, for ROE, the number is above 20. If this is below it by a little bit, depending on the other numbers, it can be acceptable. It's, of course, your choice, but I usually wouldn't go below 20. Below 10, I would say, as the very beneath, maybe even 15, but just keep that in mind. That'll bring me into my next point. This is debt. Debt is very variable in that in a lot of different industries, it has a very different idea of what's a lot of debt, what's a little bit of debt. In an overall looking at industries, basically you want lower than 1 on a debt to equity ratio. All of these, this is not a sponsorship, can be found on morningstar.com, and I'm going to post a video later on about fully navigating that and showing that whole thing. But basically, debt to equity, so that is debt divided by your equity. So you might have, if you have a huge company and like a $200 billion company, and you have $2 million in debt. $2 million seems like a lot, but since you are a $200 billion company, it's nothing compared to it. So then you get a very low score. And basically, it shows the debt relative to the size of the business. And with this, then you can really show what that is. So you never, when I say 1, that just means, think about it, that if you have $100 million in debt, you never have more than $100 million in equity, so that your equity can combat the debt. In some industries, they take on more debt than they're worth because that's what they need to sustain themselves. That is very noticeable in the vehicle industry, especially with aircraft, because an airplane or a spaceship costs a lot of money to build initially, but then you can also make a lot of money from it by selling a plane for hundreds of millions of dollars, but you first have to take on hundreds of millions of dollars in debt to build it. So they even each other out, and with these complex designs, they obviously make a good profit. But you have to consider these things when you're thinking about what industry this company's in. Okay, the next thing is dividends. Dividends are, everyone loves to talk about dividends because they're money that the company is directly giving you. If you own a share, then it might be anywhere from 0 to like a couple dollars. It's usually not that much because companies that have higher dividends usually aren't worth that much. But this is also relative because if you're spending $1,000 to buy 1 share of a company versus $1,000 to buy 100 shares of a company, you're getting the same amount of net worth, or the same amount of worth, market value from both of those companies. You're just buying different shares. So if you were to get a 5% on the stock that was $10, which would mean that you'd be getting 50 cents for every share that you have, and you were to get a 2% on the 1,000, that'd be $20 for 1 share of the 1,000. But if you're buying $1,000 of each, then you get $50 from the $10, which you're buying $1,000 worth of, and then so you end up actually making more money. So that is basically the way to think about that. So there's different ways that people think about dividends. A lot of retired people like companies with very high dividends, and they try to basically just live off the dividends. I'd recommend, if you are not retired, to not worry as much. If you find a company that has a good dividend, and you can definitely use it as another proponent to buy that stock. But I wouldn't say if there's a really good company, it doesn't have one, for that to really turn you away from it. Like Berkshire Hathaway, a great company, as you can just see through history, doesn't pay a dividend. But if you invested in it a long time ago, you could be a millionaire from investing a couple $100. So if you can time this right. So that's the whole idea, is that just don't throw the baby out with the bathwater. Okay, now the last of the 5 points that I'm going to talk about today is price. This is a complicated topic. So most people, when I say price, most people think of the price, the stock went down. The stock went down 5 points. The stock went up 10 points today. Like, all that. All these things, that's what everyone loves to talk about when they think about the stock market. But the thing is that when I talk about price, I'm talking about the PE ratio. This is the price to equity. So how much does it cost for how much you're getting? So if you notice that basically all of these, you're comparing the price to, or you're comparing something to equity. And that's because that's a really important piece of the business, is the equity. So the price of the stock versus so how much are you getting for how much? If I'm giving you $5, it's getting like 3 burgers versus getting 5 burgers. Like, what are you really getting at the end of the day? And that is a really important thing. Obviously, if you only have $1,000, you're not buying a $10,000 stock. Or if you have $50, you're not getting a $200 stock. So price is something to look at, but if there are multiple stocks under that you can buy, I wouldn't buy the $16 stock if a $50 stock is better. Or buy one $50 stock and think you're buying more when you could just buy multiple $16 stocks. And with this logic, just realize that if there's a cheaper stock that's better than a more expensive one, you can buy more or to compensate for that. Also, if you're spending a little bit more now, then you should be putting, if you can afford it, you should be putting as much as you can into your retirement if you're not retired, and then you can get a better return, and then you don't have to put as much in later. So that your life's just getting exponentially a lot easier and a lot better because you put more money in earlier. It's basically the idea of that if you put $10,000 in your retirement fund at the age of 30, great, but you have to put in money continuously, basically until you retire. But if I, as a 15-year-old, put $10,000 into my retirement right now, then I wouldn't actually really have to contribute much else for the rest of my life. So that's the whole idea of timing. And that's why I say it's not a get-rich-quick scheme, because I will get a solid retirement fund, but it's going to take me 50 years or 45 years. And that's why you really need to just start earlier, and you can get a much better return. So for the PE, I would say under 20, because for this, unlike the ROE, you want it to be lower, which means that you're getting a better price. So basically think better, lower, better price. It's like paying $10 versus $5 for the same thing. And I also like to use 20 because it's a good number to judge it on, and you can remember it with the ROE and ROIC. It's the same number. It's just one you want above, one you want below. And just a quick back to the dividend. So when I'm talking about dividend, what I really am talking about is dividend yield. Other people will talk about living off of only dividends, which is a legitimate way to go. I just don't really have living costs right now because I'm in high school. So I just invest all of my money and I do something where I reinvest the dividends, which basically means that if you don't need them to live or you just aren't accumulating enough of them that you can live off of them, reinvest them so that you can buy more shares, and then eventually they might accumulate to a place where you can live off them or where you have significantly more money. And also, I'm talking about when I say dividend yield, that is measured in a percentage. So that's what I meant when I was saying the percentage, not the amount of dollars really you're getting, although you can figure it out with some really easy percentage math. And so that's all I have to talk about today. Thank you for watching. If you want to see more videos like this, please drop a like down below. I'll actually give that a second. Okay, thanks. And then it really helps with the YouTube algorithm. Also, subscribe and hit the notification bell so you're notified when I post a video. Also, hit me up on Twitter. That should be linked below, and it's also in my channel page. So thank you, and I'll see you next time.